Welcome back to the COVID-19 Comeback video series. I'm John Mitchell, here to introduce the fourth and final segment for commercial borrowers. As with earlier shows, we're asking two of our top lender lawyers to give us a look behind the curtain and share their experiences. Back to speak with us again is Mike Mueller, chairman of our Restructuring and Bankruptcy practice, and Matt Cheek, who chairs our firm's Financial Services Industry Group. Up till now, we've spent time on the way banks look at troubled loans, how psychology can play a role on both sides, and the range of protections the lender may pursue. Now at last we come to forbearance and restructuring, which really is the best outcome when good loans go bad. As counsel to banks, we hope our videos give borrowers some helpful insight that will lead to more constructive dealings with their lenders. Mike, I'd like it if you could start out by explaining what exactly is forbearance. How does it work?
Sure, John, and thanks for the introduction. A forbearance agreement is an agreement by the lender to forbear from enforcement of remedies or collection activities, typically in exchange for certain agreements and concessions by the borrower and other obligors such as guarantors. In addition, the lender may agree to postpone or suspend principal payments during the forbearance period, although if possible, the lender typically likes to collect interest payments during the forbearance period. Usually, before I enter into a forbearance agreement or even to discuss negotiations for a forbearance agreement with borrowers, I require a pre-negotiation letter. And a pre-negotiation letter is where it contains many of the same standard terms and conditions and boilerplate contained in forbearance agreement, including acknowledgement of defaults, acknowledgement of the loan documents and indebtedness, including amounts owed and outstanding, acknowledgement of no defenses or to the indebtedness, and release of claims, offsets, or defenses against lender. After I get the executed pre-negotiation letter, I can then sit down and start discussing with the borrower the terms of a forbearance agreement. And it's important to understand that a forbearance agreement sits on top of the existing loan documents, meaning it's the most recent controlling document. However, all the other terms and conditions of the other loan documents, unless specifically modified by the forbearance agreement, remain in full force and effect. And a forbearance agreement has typical structure or content, regardless of the lender or who's drafting it. After the preamble that defines the parties to the agreement, the forbearance agreement will contain several recitals which summarize and define the loan documents, including the debt instrument, promissory note, or loan agreement, including any modification agreements, any collateral documents, including security agreements, deed of trust, perfection documents, guarantee agreements. It will describe and define the loan defaults, and it will also describe the default notice, including acceleration if the loan has been accelerated. Then comes the agreement portion of a forbearance agreement, which also has typical standard terms and boilerplate, some of which I just covered in discussing a pre-negotiation letter, but they include acknowledgement and incorporation of the recitals, acknowledgement of the defaults, acknowledgement of loan documents and ratification of same, acknowledgement of the indebtedness and the loan balances, acknowledgement of no defenses to the indebtedness and that the liabilities are in full force and effect, acknowledgement of guarantees and enforceability of same, release of claims, offsets, and defenses against the lender. Many times it'll have what's called stay waivers, which are waivers of the automatic stay in the bankruptcy code, which depending on the jurisdiction you're in and depending how many times you've entered into a forbearance agreement, may or may not be enforceable. Jury trial waivers and jurisdiction provisions. One of the other things a forbearance agreement will do will adjust the maturity date. If the loan is not matured, a forbearance agreement will typically have a new maturity date, which is typically the earlier of some specified date or a forbearance agreement event of default, which can include, and usually does include, new defaults under the loan documents, as opposed to the existing defaults. If a loan is already matured or if it's been accelerated, The forbearance agreement may extend that due date, but it won't necessarily decelerate the loan, provided that the borrower abides by certain terms and conditions. And that's where it's the other terms and conditions that are trying to govern the performance of the borrower and the behavior of the borrower. And Matt's going to talk some more about the other terms and conditions where you get creative in the forbearance agreement. Matt?
Yeah, thanks, Mike. I like several of the things you said. For example, the forbearance agreement sort of lays on top of or sits on top of the existing pile of loan documents. Those are still effective as modified by the forbearance agreement. Sometimes that concept is a little confusing, but I think you said it great. The other thing is just to remember how we got here. You know, with this fourth session here, we got here through a series of, we talked about psychology, we talked about truth telling, we talked about fair dealing and good faith. And if all of that works, it should sort of culminate in the forbearance agreement. So when you hear some of the things that Mike is listing off, like ratification of the debt, ratification of the guarantees, ratification of the loan documents, no claims or offsets or defenses, it's basically not intended to, it's really not intended to feel heavy-handed. It's intended to level set and basically put a clean sheet of paper on the table where both parties can now negotiate in good faith about a new plan. What is the new path to success? What's the new plan? And Mike laid out the anatomy of the forbearance agreement very well. When you're working on a new plan, it can include all kinds of things. In fact, it's an area of tremendous creativity. One very common element of the guts of a forbearance agreement will include what I like to call a game reset. You sometimes will get a game reset on things like UCC or title searches, just to make sure everybody knows what everything is. It might include some updated appraisals. Nobody likes to spend extra money on appraisals, but sometimes just knowing what the bank's honest exposure is part of the name of the game. Sometimes appraisals work in the debtor's favor, quite frankly. It could very well include updated financial information, updated financial disclosures that are being given by borrowers and guarantors. What is the wherewithal of the borrowers and guarantors? And on that point, I would just say this is a time for truthfulness. This is not a time to be evasive. That is absolutely not the spirit of this portion of the game. The more truth, the better. If everybody's in the truth business, the path to success will be more wide and with more options than if the opposite were true. You could see that coming together here in the forbearance agreement. Sometimes other updates might be things like updated corporate resolutions to verify that everyone who's signing now has the appropriate current authority. Similarly, you might be getting updated insurance certificates, updated property or liability insurance, things of that nature. Game reset, that's what I call it. Now, in addition to all of that kind of stuff, then you get into the question of what can the restructuring terms be? And there are as many answers to that question as there are stars in the sky. Every situation is radically different. What are the types of creative tools and options and ideas that are brought to the table? It could be a plan of adjusted financial performance covenants where previously the covenants were at this level, now they're brought down to this level, then maybe they slowly ratchet back up. Maybe it's a plan looking at the very realistic future, looking at very realistic projections, and looking at very realistic possibilities perhaps to take the debt and to start knocking it down and have a curtailment plan. Maybe the plan is to look at all of the collective assets. What are all the chips on the table? What is all the collateral? Is there stuff that's marketable? Is there stuff that could move? And to start to develop a plan for potentially marketing or unloading some of this collateral in a methodical, orderly fashion. Again, that's where the appraisals come in, the truth of the value. And it might include things like benchmarks for performance to start marketing the property, to list a property, to talk to an auctioneer, to start getting brokers' opinions of value, or study the industry for, what the XYZ printing press is going for these days, and to start looking at how do we market it, and then a plan for getting a purchase contract in place or a sale contract in place by a certain date. The controlled sale of assets, the controlled curtailment or reduction of principal. There might be other special efforts that a company could undertake. This time is so creative that there are instances where a bank might actually choose to lend more money, because sometimes the company needs a little something, perhaps to do some capital expenditures, or maybe a small acquisition or a piece of equipment or something that'll give them that boost. Or if they just got this one contract from Lowe's or whatever, if they could just get that one contract, they'd be back up and running, and they just need a little bit of CapEx money to get to that point. Sometimes that's absolutely part of the forbearance plan, no doubt. Sometimes you have provisions around things like excess cash flow recapture, where, for example, if a company exceeds performance, has excess cash, if it's doing pretty well in the future, we're going to take a chunk of that and we're going to use it to pay down the loan. You might also start to really look carefully and start to carefully control dividends and distributions for reasons other than tax purposes and whatnot. Sometimes the debt can be completely restructured into A note, B note, C note, where you have a different curtailment or repayment plans for A note, B note. Sometimes, depending on the extremity of the situation, there might also be a plan for debt forgiveness. Remember, debt forgiveness is a taxable event. Don't forget about that in terms of income. But debt forgiveness is sometimes part of the program if it makes sense. Mike, I'm probably missing 100 other great ideas, and it's really hard to do this in a session like this because every situation is so radically different. But did you have any other techniques or tools or restructuring elements you wanted to mention? And in doing so, don't forget to talk about the potential role of a turnaround consultant.
Well, thanks, Matt. That was the one thing I was going to mention, is that in addition to all the creative ideas you mentioned, you can change the payment terms. You can look at trying to bring in additional capital or liquidity from, or require the principals to do so from insiders or whatever. One of the things that banks sometimes require is for the borrower to hire a turnaround consultant. And as we talked about in the first video, this is not something to shy away from as a borrower or run from. If the bank is asking you to hire a turnaround consultant, they view some deficiencies in operational issues, either from a management perspective or just from operationally. And so the idea is to enhance the value and hopefully increase revenue stream, increase profitability. If a bank or a lender asks you to hire a turnaround consultant, what they'll do is they may suggest 3 or 4 names to you, but the borrower interviews the turnaround consultants and the borrower hires the turnaround consultant. And that's important because the turnaround consultant works for the borrower, not for the bank. The bank may require in the forbearance agreement direct access to the turnaround consultant, financial reporting from the turnaround consultant. But again, the idea is that the turnaround consultant is in there to look from operationally, how can we increase revenues? How can we increase performance? How can we increase profitability? Are there expenses that can be cut? That kind of thing. But just importantly, from the bank's perspective, hopefully the turnaround consultant will improve financial reporting back to the lender. And a good turnaround consultant, if a borrower embraces that, can really save the day at times. A lot of times I see borrowers resist because it's their business, their company, and they don't like the outside influence, and they think somehow that this is just it's almost like a mole for the bank inside the business. And that's actually not true. The turnaround consultant, I'm repeating myself, but it works for the borrower. He or she works for the borrower. It hopefully will improve communications with the bank. And as we talked about in the first video, communications with the bank at this particular juncture in your business's life, when you're in financial distress, is a good thing. It's not a bad thing. And hopefully by doing so, the whole point of all of this is to resuscitate the borrower if you can. And as you like to say, Matt, hopefully the money is greener for everybody if you're successful in that effort.
Yeah, because Mike, something that you just said triggered. So for example, what is the goal in all of this? And that is frankly for everybody to come out of the other side successfully. And I think sometimes there's a reluctance to actually believe that. But baked in what you said, Mike, is a real truth. If you liquidate a company out, basically you're going to lose. You know, everybody's going to lose. More often than not, even if you're pretty well collateralized, the expense, the pain, the hassle, the time of liquidating collateral, everybody is usually better off if you can work the thing out. To your point, mechanically, you mentioned before the forbearance deadline. So the new forbearance maturity date, if you will, the end of the forbearance period. Well, what's interesting is if the plan is realistic and it's honest on both sides, and if the plan is working, then that forbearance period will hopefully get extended and then maybe extended again. And the rehabilitation is working in an honest fashion to the point that you ultimately don't need the forbearance agreement anymore. And you go back, you restructure the debt, you go back to kind of where you were before, et cetera. What's really fascinating about this is that, and I really think debtors who are understandably fearful at the time don't realize just how desperately banks want to see this happen. Not just because the money's greener for them, but also because there are some unbelievable success stories of true relationship loyalty between banks and borrowers. When a bank has stood by the borrower during this time, has seen them through a tunnel, sees them to the other side of the mountain, and cements that relationship to such a degree that from that point forward, the borrower wouldn't bank with anybody else. That type of loyalty is actually desired by many, many, many more banks than you might think, and bankers. So just bear that in mind. And Mike, in closing, I don't know if you wanted to add anything to that about kind of we've characterized forbearance agreements as sort of a honest hope for success. And I think there is a degree of honest hope to this. Do you agree with that? Do you disagree with that?
I 100% agree with that. The bank doesn't want to liquidate collateral. It doesn't want to take collateral back in OREO. It much rather have a performing loan. But the key to all of this, to get through the mountain, get through the tunnel to the mountain on the other side, as you said, goes back to our very first point in the very first video. Communication is key. If you want the bank to help you out of this situation and be your partner in this situation, you have to cooperate with them. You have to be open with them. You have to be honest with them. You have to communicate with them. You have to run to the problem. If you don't do that, the bank is going to be reluctant to work with you because it's going to lose trust in you. It's going to lose trust in your abilities to manage the situation. But more importantly, it's just not going to trust you. And when you don't trust the partner, your options are a lot more limited, and the bank's willingness to work with you is going to be severely limited.
Wonderful, great information from the two of you. Thank you both for joining us on this. I want to say that's a wrap on this particular set of videos. Thanks to the two of you for sharing your knowledge, and thanks to our viewers for tuning into the series. I hope you found the discussion timely and useful, but I'm sure we left you with some questions, so we welcome follow-up with any of the panelists. Contact information is at the end of this video. And please be sure to visit williamsmullen.com. Every week we are posting new resources to help your business make your COVID comeback. Thank you, everybody, and please be well.